Hi, everybody. Welcome to a brand new month. We're into June. June 3rd, the market update desk with Scott Riley and sponsored by Mortgage One. We ended last week definitely on the green or good side. We had some tough sledding to start the week last week with some weaker than market expected bond sales. We had three different ones, 2, 5, and 10-year bond sales that were met with less than the expected excitement in the marketplace. But we picked up steam later on the week with weaker than expected second look GDP and neutral to slightly better PCE inflation data. So the market absorbed that, took that into play, and ended up last week in the positive. And we are starting rolling through that and into positive news in areas this morning. Globally, the ECB, European Central Bank, indicated they will likely start cutting rates this Thursday. Now, this is definitely a important factor because the Fed's going to need to see this, that the rest of the world is going to start to move towards some easing of monetary policy. And that's going to put some pressure potentially on the Fed to start to look past their mandate maybe of waiting to 2% and opening up some of that tightness that they've had on the markets over the last 2 years. Now, manufacturing data came out today and spurred the bond market in the positive territory and mortgage-backed securities. The ISM Manufacturing Index reported that for May, the overall index dropped from 49.2 to 48.7, which was weaker than expected. The market was calling for 49.6. Now anything under 50 is still considered contraction. So we are in that contracted format with manufacturing. New orders were weak, falling from 49.1 to 45.4. That's a pretty big drop off and are now deeper in contraction from where they were. Prices paid fell from an index of 60.9 to 57. That is a harbinger of potentially some better inflation data. So that's a positive news, especially for the bond market, because it is so moved by inflation data. Now, this week is really going to ramp things up because, believe it or not, we're at jobs week again. So tomorrow we are going to get a look at the JOLTS report, job opening and labor turnover survey. Wednesday, we get the ADP payroll. Thursday, we're going to get jobless claims, and as we've been following, that has definitely, it seems like a manipulated number by BLS because there's statistical improbabilities with the numbers that they're putting out for the last 2.5 months. Then on Friday becomes the big whale for the week. We get the BLS jobs report. Now, unemployment is going to be the biggest factor that the market's going to look at. The market's expecting us to stay flat at 3.7% unemployment. If that ticks up, we are going to get through potentially the next level of resistance that we're at right now for mortgage-backed securities and 10-year bonds. We moved it up past one resistance level. We're going against a couple Fibonacci levels. If we can get some slightly worse than expected job growth and unemployment numbers, we could break through that and move forward to some better rates. So those are some positive news that we're looking at this week. We are anxiously awaiting those numbers. So like I said, the big one is unemployment. If we can get above 3.9 unemployment numbers, the market's really going to like that. So let's stay on top of things. Keep a watch for all the data as we get it out there to you. We hope you have a fantastic week coming up. Stay tuned to the Market Update Desk, your singular original market news site for West Michigan market information. 616-293-2189. Have a great day.